Yeah. Yeah. there. right, you guys ready to go? All right, that maybe should be it, huh? Yeah, hey, welcome. Let me get things moved around. I got to move this window over there, that window over there. I got to do this, that, and the other thing. All right, yeah. So how you doing? Comment allez-vous, how are you? Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. How do I look? I got it? Cool. So we gather here every single day to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Why would we do a thing like that? Good question. Maybe because trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Hey. Favor says, I remind him of Rick Ross. Yeah, you know, brothers of a different mother. Terrible coffee, actually, this morning. Terrible. Anyways, hey, let me know how I can help. We'll go through the charts. We can talk techies. We can talk fundies. We can talk psyches. Cool. It's an important week. What are some of the bigger events later this week? Well, ADP, Bank of England, non-farm payrolls, kitty cat job report, that kind of stuff. Yeah, so let me know what you want to do, and we will do that. Simple enough. Some resources available to you. I'd like you to visit tradersway.com. Consider them as your foreign exchange broker. I've been working with them about 8 years. They've earned my loyalty and respect. I literally recommend them. You should check them out. Tradersway.com. Investor Bootcamp. So it was originally FX Bootcamp, which I started 20 years ago. And now it is Investor Bootcamp because we want to talk about more things beyond foreign exchange, including things like, how about real estate? Quite a few of you asked me to do a real estate course. I'm also thinking of doing personal finance course. I can do one on hedge funds. I can do one on venture capital. I run a hedge fund. I consult to hedge funds. I was a venture capitalist. I worked with venture capitalists. So there's a lot that we can do there. So, right, it's still $88 a year. I think I'm going to change that. It's too cheap now. So hurry up. Take advantage of it. $88 a year. It used to be $1,000. I lowered it because of COVID. Check out Quant Box. Quant Box automates your macroeconomic research and then does comparative analysis. This is what the COT data looks like. Very nice. Take a trial. It's $8. By the way, when you log in, okay, here's today's video. Isn't that nice? So one of the benefits you get as a subscriber is every morning we do live analysis. Oh, everybody. Anyways, good morning, everybody. Welcome to Quant Box Live, where we get our macro on and uncover the best fundamental opportunities across the global markets at just slightly after 6:30 a.m. on Wall Street. Nice. That's how we do. And by the way, have you tried this yet? Look at this handsome devil. This is my OnlyFans site. Oh, no, wait. No, that's not true. This is TradePlans.ai, a new project of mine. It's free, by the way. Free! Free! AI where you can get feedback on your trading idea in less than 3 seconds. You fill out the form, you hit submit, and our trade plans will already be in your email account. In fact, when you open it up, you will see that there's a trade plan for daily, for weekly, and monthly. And again, we can do this in less than 3 seconds. Now, how is that even possible? Well, of course, I'm utilizing artificial intelligence. So my name is Wayne McDonald. I've been trading for over 20 years, and I've been teaching artificial intelligence on how to trade. So when you submit a trade plan, we have thousands of candlestick data points in which we can analyze using dozens of algorithms and help you put together trade plans. You can take what you thought with what the artificial intelligence is thinking, and you can compare and contrast. But here's the cool thing. We also track the trade over time so that the machine is learning from your wins and your successes, or in your failures, or its wins and its failures. And the more trade plans you upload and the more trade plans others upload, the better the feedback gets. So give it a try. Fill out the form, post a trade plan, and check your email. There's already 3 different types of trade plans for you to compare and contrast with your own. Try it out. It's awesome. It is awesome. Dude, seriously, you got to try it. So imagine before you pulled the trigger on any trade, you just double checked it and got a second opinion. That's it. And it's almost instant. Right? So right now it emails it to you. I'm thinking I want to switch that out to a text. So you fill this out, you hit submit, and I want your phone just go pa-ching, like a half a second after you hit submit. Pa-ching. Here it is. It's on your phone. Our feedback. You're like, whoa, what? Like, it's that lightning fast. So anyways, ridiculous. Just absolutely ridiculous. So you honestly need to try it. It's going to blow you away. It's incredible. Oh, ba-ding. Hang on, I got a lot of moving parts today. Yeah, all right, well, all right, that's good. All right, cool. We're good. All right, so yeah, woo. Oh, you know what I forgot to tell you too? Do I still have it up here? Check this out. You ready? I forgot to tell you. Let me expand this. You could trade, you can post a trade plan for Apple computers. How about the S&P 500? Okay, you already know if you're doing euro dollar, you just build it, euro dollar, and you can find it that way. So wait, so you can do the S&P 500, SP 500, yeah. You're like, Wayne, well, what about, I don't know, if I can type, how about Bitcoin? Oh, snap. How about, Ripple? Yeah. So we're adding more assets. That took 25 hours of work this weekend to add those assets for you. 25 hours. I had to pay for 25 hours. Yeah. Anywho. Okay, anywho. What do you think about this possibility? Right now, it's only a hypothesis, but it's interesting, huh? Okay, that would be a game changer, and that's what we're watching. Here we go, bring that across. You see what I mean? It's not that it will happen, but if it happened, it would be important. And we're very close to the price. We know the price in which to expect it. We've already tickled it at 33.50, we'll call it. We already tickled it on the daily. So if I drop into a 15-minute chart, you'll see there's the tickle. Tickle, tickle, tickle. Okay, see right there? That could be it, or you can have one more up and then a down. But the thing is, at some point, if you thought down off of a double top, you need to really start considering what's happening as the possible beginning. So you could be waiting for something more like that, or just a different variation where maybe that was close enough. What if it starts doing this? At what point are you on the clue train? Does anybody know how to make a trade if this happened? If this double top formed, held, and then created lower lows and lower highs? How would you trade that? You probably don't trade the Japanese stock market, do you? Yen, but how? Are you a buyer of yen or seller of yen in that scenario, JP? Yes, buyer of yen, seller of pairs, yes. So, JP, what did you think of that surprise hold by the Reserve Bank of Australia last night? They decided not to raise interest rates, even though some folks thought it would be up. Shocking news, huh? For those that weren't there, this has to do with the conversation in the day trading group last night. JP was going through, we'll call it a media website that had a calendar. Okay? And the calendar said that the RBA was expected to raise interest rates. And so JP had a question about this. I'm like, who the hell said that? So he mentioned the site. And I'm like, well, how did they come up with that outlook? He was like, I don't know. And of course, you don't know. They're just like, yeah, obviously the market expects an interest rate hike. I'm like, well, that's weird, right? And so instead, JP and I, Jim and I, and the rest of the day trading group went through and looked at the facts. And I'm like, they're not going to raise. They're not going to raise. I mean, they could raise, and then you look at the data and there's a lot less need to raise, and you can further look at the data and say there's a lot of risk to raising. But besides all that, quite literally, they told us they weren't going to raise. Right? So Ashish says, yeah, the RBA mentioned that the Australian economy is below growth. Well, we knew that, but even then, that just points to they might not raise. I'm taking it to another level where they already specifically told us they will not raise. It's more than there's a good chance they won't, or we assume they won't. They literally told us they wouldn't raise. And so that's when I'm like, who the hell told you they were going to raise? Oh, well, it's on this site. Whatever the site was, it doesn't matter. But I'm like, you can't go through some calendar and pay attention to the expected outcome. I'm like, you need better data than that. That's very retail. If you were a $1 billion hedge fund, you wouldn't use retail data. You would have your own research team. You're like, but Wayne, I'm not a $1 billion hedge fund. Yeah, for $80 a month, or right? for $800 a year. $800 a year. You can have the same data as $1 billion hedge fund. Right? And so anyway, so last night was just like a massive high five, like, yeah, boy. Yeah, boy. Right? Just like, yeah, nailed it. And made me happy anyway. So I hope it made JP happy. Ashish is right, though. There's a lot of concern in Australia about inflation now eating into and changing consumer habits, consumer spending, household debt, household wealth effects, that kind of stuff. So, JP, we were talking last night that we didn't expect the rate hike that was reported to happen. And so the assumption was there'd be a big drop in the Aussie dollar and that you could be able to trade it. Were you able to catch the Aussie dollar short? And even if you didn't, you can see the observation now going back in time of what happens when the market is wrong. What happens when the market is expecting something that shouldn't be expected. I mean, that was the whole thing. I only know what the RBA told us. Now, sometimes that is wrong. Like, I remember, must have been a couple of years ago now. I remember I was outside and it was like midnight and I was listening to an RBA speech, and he said that they would not raise interest rates until, I don't know, I can't remember, inflation was at a certain level or unemployment or you know, whatever their indicator was. And we were nowhere near that indicator. And he said, we're not going to raise interest rates. We're not thinking about it. And we wouldn't think about it until, like, let's say inflation starts with a 5 or I can't remember what it was. I don't think it was inflation. But nonetheless, they gave us like, we're not going to do it. We're not thinking about it. And we're going to look at this indicator, but that's a million miles away and very unlikely. Okay? Now, what happened is very quickly they changed. They ended up raising interest rates. They were late to the game, but then suddenly something snapped. And it was not because that number was hit that they were talking about, but they just changed their attitude. And so, like, nothing can predict the future, but you should base your hypotheses on facts. And certainly not on, you know, on the media or on what some YouTube guru said or something else. In this case, the RBA said what they're going to say, and this time, and I would say most of the time, it should be accurate. The central bank doesn't wake up in the morning and say, hey, we want to lie to people. They're focused on transparency. But in the case of the COVID crisis, they did change their tone quite quickly. But I think that would have been because there was a global pandemic type crisis and not your typical, let's say, business cycle recession. Okay? Does that make sense, everybody? That in lieu of a global pandemic, central banks don't adjust very quickly. They're very focused, they're very patient, they try to be as transparent as possible, but for some reason, retail Forex traders and other retail investors simply don't listen. And often it's because they don't know what to listen to. All right, so let's take a look at some other assets. Golly gee whiz, Batman. Oh, God. Look at that, dude. It's cray-cray. It's cray-cray. Is it happening? Is it a tsunami? I gotta move. Give me the juice. Look at that. That is interesting. Holy smokes. That could be a doozy. What do you guys think? Is it the beginning of, let's say, 3 weeks of down? Anybody think we could go somewhere between 5 and 10% down for the S&P 500? So let's say 10% down is about 500 points, right? So all the way back down to 4,000? What do you think? 4,100, I think, is what I said at one point. I don't have that on this chart. 4,000. Wait, where is this? We have to go further up for that one. Oh, yeah. We want to do it this way, I think. Oops, no. Let's redo this. Let's do it like this. Well, you know what? No. Well, hang on. Where should I do this? Do it this way? $42 is a 382, but I think we played that out already. I'm not sure how to do, I don't think I want to do a fib anymore on this. I'll delete it. So not 35. I think that would be too much. I don't think we have a crisis yet. I'm thinking fade, not full-on reversal. So maybe a 382 of this leg. Let's take a look. I said 41. That's a 618. Roll reversal off of this area. Let's call this the double top, 618. So about 41. Yeah, still. What do you guys think? That would be about a 500-point drop. We'll call it 450 drop on a 4,500. So a 10% drop. A 7% drop gets us to the 200 EMA. Insert indicator, trend, moving average, Bollinger Band, Dodger Blue 100, simple. I just want to show you the similarity between the 100-day simple moving average and the 200 exponential moving average. Same thing. I think statistically speaking, it's the same thing. And I've been using 200 EMA for 20 years. And it just might be lucky because like stock traders, they tend to use the 100-day simple moving average. But the relative difference is almost nil. You get the same kind of data. So anyways, what do you think of this, guys, moving forward? A 10% drop in the S&P 500, and then we make a new high. We make a new all-time high. What do you think of that? Now, Jim Rogers, who I had correspondence with several months ago. He's a billionaire commodities guy. He was one of the co-founders of the Quantum Fund with George Soros. He has a running theory right now that because, and I think this is his opinion, but if not, I'm going to add to it, okay? That because we haven't actually fixed any of the problem. What's the problem? The Fed added $5 trillion, and I've proved that, by the way. In the third quarter outlook, I've proven that the things I've been saying are factual, which is pretty good. I fact-checked myself. So I showed the increase of the balance sheet at the Fed, and it is by $5 trillion. And I said the Fed has added $5 trillion to the economy during COVID. And now they're in the process of unwinding that. They can remove that $5 trillion. Now, it's going to take 10 years, but they're doing it, and I've proved that they are doing it. Okay, that's $5 trillion. Now, the federal government, not the central bank, the federal government also added $5 trillion, and we saw that in deposits. Okay, so I also showed that in the Q3 outlook. Now, here's the issue. To fix inflation, we have to take out that funny money. The Fed added $5 trillion of money it made up. There was no productivity. This was just made up money. Okay? And then the US government, the Treasury can't really print the currency. So what did they do? They borrowed money. They issued treasuries. They borrowed money. So there's $5 trillion more debt than there used to be, for a total of $10 trillion. Some of it coming off, half of it slowly coming off, the other half not coming off at all. And there's the problem. Okay, there's the problem. And so if that $5 trillion stays there, then a couple of things happen. Inflation never goes away. So now the federal government might have to do bad things. Instead of addressing the inflation, all they know is there's pain. So they avoid the pain, sort of the costly, ugly, messy solution, because the longer you delay fixing it, the worse it gets and the more complicated the fix is. So you just delay and defer. And so you'll always be tempted as a government to cheat, take the shortcut, because you got to get reelected in less than 4 years. So you're never going to take the 10-year fix. Like the Fed is taking the 10-year fix. A government's not likely to do it because they have less than 4 years before the next election cycle. So they're going to be tempted to cheat. Like give away more free money. Oh, you don't have money and prices are high? Well, we'll give you more money, which only makes prices go up. And by the way, one of the things I proved during my third quarter outlook was the vast majority of, that there were two types of people during COVID. And I mean this like from an economic point of view, because I could show it in bank deposits. There were people that got stimulus checks, and then there were people that did not get stimulus checks. Not everybody got stimulus checks. Okay? The people that didn't get stimulus checks during COVID are just as rich as they were before. Nothing has changed. They have just as much money in the bank, despite COVID, despite the lockdown, despite everything. Their level of net worth is the same. Now, looking at this data, we saw the net worth of people that got stimulus checks skyrocket. Why? Well, the reason they got money is they had no money. So when they got a $5,000 check from the government, their net worth went up $5,000. They went from 0 to 5,000. Then you can see it gets spent. And you know what? And this is the paradox of sort of the government. The government, I think, always has a decent, they're trying to do the best they can. They're trying to do a decent job. I think a lot of you would argue with that. But there's always the unintended consequence of government action, where the government's trying to do good things, but it almost inevitably, almost always ends up bad. And when you look at this chart, it's really amazing. And again, I covered this live, so you had the opportunity to get this information and watch the video. But I showed how the people that received money because of stimulus checks are now worse off. They have less money. They actually have more debt and less money. They've spent all the money, but now debt is up. The people that didn't get it are just perfectly fine. And now many people are worse off. They're worse off than before COVID. And it's a paradox, isn't it? Okay. Now, Greg says we have 13 years of funny money. You might be saying like quantitative easing and stuff, but my biggest point right now, and I show this in that Q3 outlook, that our response to the 2008 financial crisis, when large banking institutions went out of business, large hedge funds went out of business, the stock market absolutely, totally collapsed, and people lost 50 and 60% of their net worth. Insurance companies, reinsurance companies, government-sponsored entities were going out of business. Airlines were going out of business. Car companies were going out of business. Like, holy crap, unemployment went to 10% and above. Like, real deal, end of the world, end of capitalism moment in time, right, Greg? And our response by the US government was nothing. Okay, do nothing. And the response by the Federal Reserve was $1 trillion. And it was so extraordinary to ask for $1 trillion that they had to go back to Congress a couple of times. And the Congress said, we can't give you $1 trillion, but we can give you 950 billion. Like, it was so extraordinary that it was politically impossible. And people really thought like $1 trillion was all the money in the world. Even for the US government, that was insane. At the time of total collapse of capitalism. Well, we got COVID and spent 10 times more money than 2008. $10 trillion, which just is bonkers beyond belief. Bonkers, right? And so, yeah, look, we have a negative consequence to all of that. So anyways, it's pretty amazing when you start looking at charts and you're like, how much debt has been added to the Fed's balance sheet over time? And you simply do the analysis, right? And we look at it over time, and it's extraordinary. If you can visualize contextually where we were and where we are now, and the rate of change is like beyond belief. But it happened. So now now our leaders are struggling to identify what the problem is. I'm like, you don't know what the problem is? Is it interest rates? No. Well, we need to normalize. But you can raise inflation to 10%, interest rates at 10% in the United States. The only thing it'll do is cause a recession. And maybe the recession destroys 10 trillion. In this case, The Fed's already working on 5 trillion, so we need to destroy $5 trillion in the economy. So you can do it in a recession, but it's not controlled. How do you cause a recession and only destroy 5 trillion? What if you accidentally destroy 6 trillion or 8 trillion? Well, you might not be able to recover. Okay, too much chemo will kill the patient. So how do you do this in a controlled fashion? Well, the government should have a strategy to remove their 5 trillion, just like the Fed has a strategy to remove their 5 trillion. And you can do it over 10 years. So how do you do it? Does anybody know the answer? How would the government design a strategy to remove the 5 trillion in excess money that they added by borrowing and giving the money away for free? No, OMO is not government. That's the central bank. How does the federal government remove money from the economy? Okay. Raise taxes. Great. That's exactly correct. Now, what do you do with that money? Do you give it to poor people that don't have the money? That's called a transfer payment. Do you put it into special services? Do you pay people's university debt? You pay off, the government pays debt that they borrowed. Forget student debt. Okay? The government has to pay their debt. So not just any debt. If the government borrowed from China, if the government borrowed from the UK, if the government borrowed from the EU, if the government borrowed from Japan, if government borrowed from Saudi Arabia, we take all the money from raising taxes, the 5 trillion, okay, and we buy all those treasuries back. So now the government owns the treasuries, but they don't have the cash. The cash is gone. And inflation will instantly go away. Do you know why I know it's instant? Because money is tied to productivity. Okay? So you have GDP and you have money supply. Okay? So what happens is a company offers a product and service, gets money for the product or service, they hire employees, or return profits to shareholders. And the company is more productive. And they get money from their customers. Okay? And where does that go? Once again, the company pays, let's say, an employee goes to Supercuts or Applebee's and spends money, and that goes to them, and now the lady at Supercuts gets paid, and she can pay her rent, or she can go to Applebee's for lunch, and the waitress at Applebee's can get her haircut at Supercuts, and the money just, what happens? The money goes to your rent, or it goes to Applebee's. What does Applebee's do? Well, it's the same thing. Applebee's provided a service and food and service. And so now what? The money that the patron has paid for lunch goes to buying the food, goes to let's say, the waitress, the maitre d', the kitchen staff, the busboy, they all get paid. The owner of the Applebee's gets paid. The landlord collects rent. And this is all coming from the money. And then all those people pay their rent. And it goes to the landlord. And the landlord does what? Owns this building, which is providing a service of location. And this goes around and around and around. What happens? The same dollar circulates over and over and over. We call this velocity. The velocity of money. Around, 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 around it goes. And the bigger the economy, the more demand there is for this money, and the more likely you're going to spend it. And it goes around and around and around and around and around and around and around. Right? No inflation. There's no inflation. Okay? So how do you get inflation? The money supply increases, and it's not because of some sort of return on investment from an overly productive company. No, you increase money supply, and the government, what they do is they don't have any money, so they sell a treasury to, let's say, Japan. And Japan buys the treasury, okay? And somehow this money that shouldn't exist gets put into the economy. And it's just debt. Okay? I was looking at Porsches a few weeks ago, and I was actually very surprised, very, very, very surprised, because some of the Porsches, they were advertising them by monthly payment. And they're older Porsches. I don't want a brand new Porsche. They're older. But they're like, you can buy this old Porsche with high miles and pay this low price over the next, it was like 5 years or 7 years or something. And it was extraordinarily expensive for an old Porsche that probably has super high maintenance that is not being priced in. And anyways, my point here is it was very clear when I looked at this is they were selling cars to people that can't afford them. They were just going to borrow a whole bunch of money and put it into an asset guaranteed to lose value. And it was just, I don't know why someone like that would want to drive a Porsche. It doesn't make any sense to me. So if looking at your own cycle here, if you are not productive, so if you have no personal GDP, you should not find ways to increase your money supply by borrowing from somebody else's money supply. See, somebody else has excess money. So why would somebody with little money borrow from someone else's excess money so now they look like they're rich? It's really bad logic, right? It's really a shame. Where if you don't have money, you shouldn't pretend you do. And you should change this part of the equation, and not through debt, but through, first, how do you do this? Increase your GDP. Okay? This is the old adage of like, work 3 jobs. You'll be super productive. And you'll increase your money. And then what do? Okay, you increase, right, your net worth, not your debt. So what do? You fund your Forex account, for example, and only work 2 jobs, but your third job is your Forex. Okay? And with patience and discipline, you increase your net worth because you're increasing your productivity and your income. So your productivity goes up, but because you're a successful Forex trader, now your money has gone up. And you can do this for as long as you want, and then at some point you don't want to work 2 jobs, so you want to find like maybe a passive income. So you have a full-time job and a Forex trader, and you bought and you've put together a stock portfolio, which are assets, by the way. So you're constantly putting some money into like a retirement account, pre-tax. And this is money that you convert your money into an asset. So you don't have enough money for a TV. You don't have enough money to go to a bar and spend $1,000 on champagne and beautiful people that want to hang out with you because you're simply spending your money. No, you're like, I can't afford that. Yes, you can go buy a bottle of Dom Perignon. You have $300, but you decide I would rather own assets than spend my money because you're focused on getting your net worth up, right? So I like to think of it as it's the same model, that the government has for managing its money supply, and it's worried about inflation. Okay, if you borrow money because you ain't got no money, what happens? Your productivity doesn't go up, but now you have more money. But is it real money? No, because it's money minus debt. So nothing's changed. And now you take this debt and you buy something worthless like a car. What a dumb idea. And so now you have less and less money, more and more debt, and a car that probably will need a $10,000 tune-up or a repair bill, and you don't have any money, right? Terrible, just real terrible, really, 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 really terrible. Okay? Yeah, so you got to be smarter with money. I have a friend who owns 7 houses, and I think the newest car he owns is probably 8 years old. Okay? Yeah, actually, Darko, I can already do that. Yeah, I just haven't launched it yet. But thank you. It's a really good thought. Yeah, no, Darko. The issue is how do we integrate our back office, our back end with the front end? Okay. Anyways, yeah, we can go back and do some commodities. So I talked about it again, or a few weeks ago. I haven't brought it up recently, and I think it's just we're trying to figure out a model. What if I did a training course, guys? Follow me on this thought. What if I did a training course on portfolio construction and portfolio management? Okay. Oh, Sky Killer, just use the Fred. That's easy. I do a course on portfolio construction, and you have the opportunity, let me make up a number here, $200 a month. So maybe you're not a member of Investor Bootcamp at all. I haven't thought it through that way, or maybe you're just a basic member, and you're like, I don't really want to do day trading, and I don't want to do swing trading. But you are interested in portfolio construction and management. So let's say there's a course, so you pay for a course, and it's, I never charge very much for a course. But then, listen, hear me through. You stay in the group for $200 a month, and we meet, like I said, monthly, more like quarterly. I think quarterly is most important, but we could do let's say we do quick meetings online monthly, and every 3 months we meet live somewhere. So we meet up in Seattle or something, and we meet as a group. So there's some networking and all that kind of stuff. But the whole point is you and I together manage an account of mine with real money in it under the rules that it's a retirement account for my company. So we just play the game the way the game is set up, and I'll teach you all about it. And we turn a $50,000 account into like $1 million account. Probably take 7 or 8 years. But we can meet, make it like a mastermind group where we can meet up 3 times a year and actually discuss what to do with the fund. What are the market conditions? What do we think the next quarter is going to be like? How did the perform? What's overperforming? What's underperforming? What needs to be rebalanced? What needs to be changed? There's a rebalance and a restructure. So we're like, oh, well, our next 3-month outlook is X, Y, and Z. So let's dump this position. Let's move money over to this other position. Let's reduce this one. Let's add to that one. And we rebalance and all that kind of stuff. And let's say it's a group of 25 people. That's it. And every 3 months, we meet somewhere. Okay. Oh, okay. Sky Killer says, what do I research at the Fred? What do you want to know, Sky Killer? So anyways, do we have 25 people, or should I quit asking? Well, you said specifically commercial real estate, right? Commercial. No? With 5 or 6, but not that many? Well. Anyways, going back to Sky Killer, real estate loans. What What do you think about that? Or how about commercial real estate prices? So one is price and one is debt. Which one would you like to have, Sky Killer? You can do prices. Have prices fallen yet? Okay. Okay. So this is a way of measuring lending standards or credit standards. Okay, this hasn't collapsed yet. Oh. All right, well, let's do a quick lesson on real estate. Okay, let's say you want to buy a skyscraper. Okay, cool. User windows. Okay, nice. Beautiful. Okay, great. You're going to borrow 70% from the bank and 30% by you and your investors. So this is a syndicated deal. So we'll say cash. Okay, great. So how do you come up with a value? Okay. Yeah, Jammer. I mean, an image of your trade plan. Sky Killer says cash flow. Yeah. So you add up, okay, net operating income, which is rent minus expenses. Okay? And then you put a multiple on this and you can get a valuation. So net, let's say on an annual basis, to make everything easy, after you collect all this rent and then you pay all your expenses, this building has a profit of $500,000. It's not much for a skyscraper, but go with me. Okay? Then the next part is you negotiate with the bank and they're like, okay, we'll give you 10 years of that income for a valuation of $5 million. So then what? If they felt you were too risky, so you personally or your team or whatever, you didn't have much history, you didn't have much experience, or you had too much debt on your personal books or your corporate books, they say, well, we're not really willing to give you 70% because if this deal goes bad, you owe us money, you owe us first. So what else do you have? If this deal goes bad, you still owe us whatever the mortgage is. So let's say no matter what, the mortgage is going to be 7%. They're like, so if something goes wrong with this deal, you have to pay us 7% a year, right, on, let's say, $4 million. So how are you going to come up with that if this deal goes bad? So they're going to look at your books or your corporate books. Do you have income from other places? Oh, you don't have any income and all you have is debt. Well, you're like, well, the bank wants to get paid when things get bad. They don't want you to come back and say, well, the economy is down. Screw you. Where's my money? Okay? You owe the bank. The bank gets paid first. So anyway, so let's say they look at you and you're fine. So this would be a typical deal. Cool. So what they do is $5 million amortized for 30 years. Okay? And I don't know, let's say, I mean, these numbers are so low, but okay, $2,500 a month. You owe the bank. Okay. All right. Okay. Sweet. But even though this is amortized for 5 years, the bank wants to deploy a strategy to always get market prices. They don't want to be locked into this for 30 years. So they say, we'll amortize it for 30 years. See, if it was 10 years or 5 years instead of 30 years, this payment would be too high. You couldn't afford this building. So they'll just say, we'll give you the loan and you'll pay the monthly payments like it's a 30-year. But it's actually only a 5-year. So in 5 years, you got to renegotiate this deal. And this bank might not want to do it, especially if you were a bad partner. But even then, they might just say, well, we have better deals other places or whatever. Something changed at the bank. They don't want to do it. So they have an easy out. Okay? So every 5 years, you have to renegotiate. Okay? So let's talk about what happens next. What if rent, the amount of rent you collect falls? And your expenses stay the same. And the value of your building went, right? Instead of you having $500,000 a year in profit, you only make $450,000 a year in profit. And your building's now not worth $5 million, it's worth $4.5 million. So you lost some of your tenants. Not many, just a few. But now the value of your building is 4.5, not 5. So the bank could come around and say, we will renew the mortgage, but for you to stay in this deal, you owe us $500,000 in cash today. You see that? Which is the old mortgage, $5 million, but then you agree that the building now is only worth $4.5 million. So to make everything equal, you owe, well, it's actually going to be 70% of the $500,000. So it'll be like $400,000, but go with me. It was worth $500,000, or sorry, you have a $5 million mortgage. Again, it's not quite right because it's you only have 70%, but I'm trying to keep it simple. You have a $5 million mortgage, but the building now, and you agree to this, is only worth $4.5. So to stay in the game, you have to put in $500,000 in cash to replace the bank's money so that the percentages are the same. Do you see that? Is it possible in the last 5 years, so from pre-COVID to now, is it possible that there are less renters in this skyscraper? And what if it's not a little bit? What if it's a lot? What if the net operating income is $350K and the building is worth 3.5? And to stay in this deal, you have to pony up 1.5 M. You're reinvesting big cash to stay in the same game in an asset that is losing value. How do you feel about that deal? Now, then interest rates rise. Okay, so now you have to also not put in $2,500, but you have to put in $4,000 a month. not $2,500 a month. It's $4,000 a month, and you have to kick in $1.5 million just to keep the building you already own. It's going to cost you more per month, plus you have to have $1.5 million in cash. For an asset that's falling on the books. It hasn't fallen in value. You haven't had to sell it yet. It's only fallen in valuation. But now you're seriously thinking about dumping this building. But you have a $5 million mortgage. So you will lose $1.5 million. You're like, ugh. Oh, either way. And then the bank looks at this and say, man, the economy sucks and what the Fed is doing is horrible and these conditions are not great. And the banking system is vulnerable, not because of the real estate market, but because of the bond market and their own balance sheet, maybe their own mismanagement during the COVID era, or really what the Fed forced banks to do during the COVID era. So they're like, we're only willing to put 60% into this deal. So you have to put in $2.3 million. It's getting worse and worse, isn't it? Because they don't want exposure to your risk anymore. You barely want exposure to your own risk. They want out. Looks horrible, right, Sky Killer? So do we care about the price? No, because that's people that have already had to dump their bad trades, aka dump their buildings already. They were the first wave in, but those are probably bad deals anyways. So price isn't the biggest thing. It's when do these credit standards that we keep talking about change? When, okay, you want to look at NOI. So right now we know rents are down and expenses are up. But then are the banks changing their lending standards? Okay? Okay? So like, for example, what's happened here is the loan to value ratios changed, where they're like, we like your deal, but we're only willing to give you 60 cents on the dollar. We'll only come in at 60%. You're going to have to be, we're not asking you, to be the majority shareholder, but we are asking you to take a bigger stake than normal. Why? We don't like you, or we don't like the economy, or we don't like the deal. But I don't think a bank would do a deal that they don't like. So it's more like, we don't trust you, or we don't trust the economy, so we're not going to take the risk. The big, we're going to reduce the level of risk. Or, right, this changes and all that kind of stuff. So the first part is just a normal valuation model. The next one is credit standards. Credit standards. Okay. And so it'd be very interesting. So I did do this in the third quarter outlook, by the way. Yeah, JP's like, hey, when does it come due? Well, remember how real estate works. These are private deals. So it's not like on the third week of August, it's quadruple witching Friday and futures and options and, all expire. No. These are over the counter, deal to deal, right? A buyer or a syndicate of buyers decide to purchase a building from a seller. And then they go out and raise money to cover the investor side, which is normally 30%. And then they go out and try to get banks, a bank or a syndicate of banks, to pony up debt. So now you have equity shareholders and debt shareholders, and you structure a deal and you put it together. But they're done one at a time over the counter, not through an exchange. Okay? Yeah, letter of credit at 8. Yeah. I met a guy in Dubai one time, that letter of credit. I was in Dubai one time talking to someone who wanted to invest in me, in my fund. And we met at the Jumeirah Towers in the big lobby, and we're just having tea or something. And he was talking big numbers and stuff. And I called bullshit. Dubai has a lot of fun stories. Most of them are not true. And I'm like, bullshit. And he thought about it for a second. Then he reached into his briefcase next to his leg, right? And he pulls out a letter of credit in his name issued like 2 days earlier from a bank for 500 million euro. So I bought him dinner. I said, my bad, you got me. I said, I'll tell you what, I'm getting hungry, man. How about you? They have a nice restaurant here. Why don't we get a steak? And in Jumeirah Towers, you can get a glass of red wine, right? In lots of Dubai, you can't drink alcohol, but in the hotels, you can. So anyways, I'm like, why don't I buy you a steak and some nice wine? He's like, yeah, man, I'm hungry too. So off we go. But yeah, credit. How about that though, huh? 500 million euro. He's like, no, I got money. Yeah, and we ended up becoming good friends. So anyways, there's another thing that you could be watching. Okay? How about delinquency on skyscrapers? You might want to see what happens if this goes up. In 2008, it got nasty. So we'll zoom in a little bit here. And these are owners of skyscrapers, for example, that are defaulting. Why? Well, remember I was showing you, they're like, the economy has changed negatively, and they're like, to stay in this deal, you're going to have to pay $4,000 a month, not $2,500. And you have to kick in $2.3 million in cash right now. By the way, you're only making $350,000 a year. So to continue to make $350,000 a year on this project, you need to kick in $2.3 million. Plus, your monthly cost is like skyrocketed. It's 50% more. So now this is going to drop even more significantly. So now you lose 2.3 million and probably break even. So what do? You try to dump the building, but everyone else is dumping their building. So then what? You walk away. You default. And boop, 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 boop. Okay? So anyways, we got to pay attention. Here we are. Boop, 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 boop. Defaults, right? Interest rate and price indices for commercial real estate. Could be vulnerable, huh? Construction and land development loans. This is for like buildings that need to be renovated. Okay. Nothing's collapsed yet. Do you notice that? So now we're getting really, okay, real estate loans, commercial real estate loans secured for multifamily properties. Okay. And they're breaking it down by different types of lender, like commercial banks and small banks. Okay. But look what's happened. This is the beginning of these deals being renegotiated. So we might next year just be running right into a change in which, so going back to JP, his question was, well, is there a place we can find out when these commercial real estate deals have to be negotiated? I don't think so, but maybe, but I don't think so because they're all private deals. But we know that in a 5-year period, right? So anyone that did a deal in 2019 is safe until next year. But things could get ugly really quickly, huh? Especially if people haven't come back to the office, then and we have inflation. What does that mean? Rent is down, expenses are up, net operating income, which is that NOI, goes to near zero. So now what's the value of the building? Near zero. But you got a $5 million mortgage. Oh, God. It's a bad deal. It went bust. COVID killed you. Okay. Okay. Yeah, Darko, Dark, I noticed that comment. I was just thinking about it. Yeah, you would have almost no argument, like if you were going to sue somebody over it. Um, the lawyers are like, dude, this guy's leverage 100 to 1. Oh, okay, that's the problem. And that would be the end of the conversation. Even if somebody lied to you or manipulated you or somehow did something, which it'd be very hard to prove that I guess you're saying your broker, did something wrong or negligent or criminal, because you have to prove intent and all that kind of stuff. And the argument would be, well, this joker's leverage 101, and that's what happens. And people would go with that. You know what I mean? So anyways, I'm sorry to hear that. I mean, but yeah. So anyways, there's some economic research for you on commercial real estate. So that's a futures contract. 40 to 1 would be a futures contract. Okay. Yeah, that makes sense, Sky Killer. That makes sense. Yeah, you don't need more than that. Yeah, there's no need for 100 to 1. There's no need for 200 to 1, but even 100 to 1 is really not necessary unless you don't have any money. But then you're focused on the wrong thing if you're using leverage because you don't have any money. It's like the guy trying to buy a Porsche that is broke. Well, you're broke. You shouldn't drive a Porsche. And if you make those types of financial decisions, you will be broke until the day you die. Okay? So I can just imagine, like, I don't know. So if you can't afford it, what did I say earlier? You're like, Wayne, I don't have a lot of money, so I need to use a leverage. No, you don't. So what are the components of making money? Time and return. You need consistent returns over long periods of time. So if you were 80 and you're like, well, I need to become a millionaire this year and I only have 10,000 bucks, I need the 100-to-1 leverage. I'd say, don't do it. You've run out of time. And you also don't have any money. So, realistically, you're only going to make 1,000 or 2,000 bucks this year. You're like, that's it. I want to turn 10,000 into $1 million and enjoy my golden years. I'm like, well, you should have started when you were 20, not 80. So you can't cheat time. Okay? You can cheat money by leveraging up. But all that does is increases your volatility and increases your risk, and you almost certainly will lose all your money. Like, what, 95% chance you're going to lose all your money? And that's in the short run. If you do that for years and years and years, it becomes nearly guaranteed you'll lose all your money. Because it doesn't make any sense. It's like the skyscraper that you paid too much for because you bought it at the top of the market and everybody wanted this building. Everybody knows it's the nicest and they have all the best tenants. And then the market crashes and you can't survive the rollover. So 5 years later, so for the first 5 years of your real estate deal, you're the king of the town. Steak dinners and fancy cigars and limousines everywhere. And you're like, I own the nicest building in town. 5 years later, you're facing a $35 million deficit. And you're out. Broke, busted, defeated, bankrupt. Okay? So you want low leveraged. And you say, well, what do I do, Wayne, if I'm like, let's say I'm 30 and I want to turn this into a business, but I don't have any money? Maybe a side hustle. Maybe you start working 3 jobs. Why? You're 30. What else do you have to do? Okay? Work 3 jobs and get really good on a demo account trading Forex, and then build a track record of 5 years of success. So when you hit 40, you can start a hedge fund, which is just a different form of side hustle. Okay? Now, why is a hedge fund a side hustle? How come hedge funds won't make you filthy, stinking rich? Well, I'll give you an example. You give me $1 million. What's it going to make? 100,000? How much are you going to pay me for making you $100,000 worth of profit? It's not a lot of money. It's like nothing. It's pretty gosh darn close to charity work. $1 million with a good return, because I'm not gambling it, of course, pays me personally, who has to do all the work, hardly anything. Okay? Hardly anything. So how do I get filthy stinking rich? I take that money and I invest it into the same thing that I'm investing my clients' money in. But I get to keep 100% of that. Oh. Call that the internal fund. Yeah, the internal fund. And now the clients like it too because you're putting your money where your mouth is. You're actually investing into what they're investing into. And now I have money that's growing and compounding. I'm collecting 100% of that. And you just keep reinvesting with your customers. And then 20 years later, it's a lot of money. Yep. But there's no get rich quick. But you see? And if you're the type of person that is trying to get rich quick, well, I don't think there's a business model around that, and it won't be attractive to anybody with money. And Dello says, hey, I'm in the market for 5 years and I can see the pattern over and over again. I can easily win a few bucks for 3 days and then on the third days I lose everything. I recommend you only trade 2 days a week. Yeah. Leverage, yeah, very little. Very, very little. So it's totally not necessary. I'd rather you study for 3 years and get really good and then spend 5 years developing a track record to prove to people that through changing market conditions, changing seasonality, changing monetary policy, okay, changing business cycle conditions, you produce consistent returns. And that's value, my friend. You need to think of yourself as a service provider. You're going to provide a service that offers value to customers and clients, and they are going to pay you for that. You're going to create $1 worth of value and ask for 20 cents. And that will be a sustainable business model. Now, if there's volatility to your portfolio and the client can't figure out, will they make 10% at the end of the year or lose 10% at the end of the year because the swings are so high and so fast that you really don't, it's almost random where you'll end at the end of the year. And 3 bad years will take you out completely. You'll lose it all. Well, gee whiz, you don't want all that. So you want reliability so that someone could plan forward and say, okay, well, there's a steady path here and, boom. So like my expected return, my expected long-term return is 13.7% every year. Okay, is that good? Well, now you have to compare and contrast. That's 40% higher return than the S&P 500, but I can also do it with 40% less volatility. So my risk-adjusted return is extraordinary. The absolute return is good. Is it great? No. Is it amazing? No. It's good. but then it's a total return. So of the, let's say 14%, okay, or let's say 13%. Out of the 13%, 3% is an increase in net asset value, and 10% is income, which then gets converted back into investment. So now your net asset value is only growing at 3%, but you're buying 10% more into those investments, more and more and more. You're compounding your net, not your net asset value, which is your paper worth, but your actual net worth goes up because you're taking that income and buying more, which produces more income, which allows you to buy more, which gives you more income to buy more. So you have more income to buy more, and it becomes exponential. So really, on the long run, you could say it's 13.7% without the compounding. But then you throw in compounding over 20 years. And it's truly extraordinary. Game changer extraordinary. But not in the Harvard textbooks. Okay, a question here. In Investor Bootcamp, you learn about day trading. Yep. And I talk about a 33.90, right? No, a 33.99 OCO, not 33.66. Although you could do that. You could do that, but it's 33.99. Okay. And you're like, well, the average daily range or average true range can change. No, but it's not a hard and fast rule. It's a concept. If you can't make a 3-to-1 trade, so look, I have a trade here. Let me show you. So anyways, I'm at a double bottom. So I'm going to move my stop to break even. All right, cool. All right, so when I sold here, if I can't make 99 pips, so I have a 33.3. So let me do this. Let me just show you first of all. Where's my EA? Oh, I don't have an EA on this one. Interesting. Well, I'll pop one for you. Auto stop. Boom. Okay. So my standard operating procedure is a 33 pip stop, 333 pip win. Okay, that's a swing trade. If I was day trading, okay, this would be 99. I don't think it's going to execute because I already have a stop on here. Let me add it. I might actually get knocked out. I've got to be careful. So I sold at 110 and it dropped to 19. Yeah, so I got room. So let me get rid of this and I think it'll OCO it. Stop loss. What's it doing now? Oh, it's doing it off this price now. Yeah, so I'm late. So let me move this back to break even. What's my short price? 110.16. So I got to move my stop to 19.16. My limit, I should say. Where did it go? 19.16. So it should just tell me here. Yeah. There we go. There we go. So there's a pissy little day trade. Okay. So let's go into a smaller time frame to look at it. What I'm suggesting is in a day trade, if you can't make 100 pips, you don't even think you're going to be able to make it, it's not a good trade. Okay? So I have to reset this as a bear. Where's my bias pivots? Let's get this set up properly. Bearish. Okay. Cool. So anyway, so today's target, let me delete that. Okay, today's target has already been achieved. You see? We're done. And the next trade's going to look something like this, and I'm going to get paid. So I'm going to get paid tomorrow, or I bust out break even today. And if I thought that that was unachievable, then I shouldn't have taken the trade. It's not worth the risk. Now, my actual target on this, because I can think forward a little bit, my actual expected target is 106. So I'm actually mentally, right, like this, that would be your day trade. But if I were me, I'd say I'm already in and I've already reduced my risk. Okay? I think this trade is worth 400 pips. I initially had it at 333, which is right in here. So I could just be super conservative, go for 107, short at 110. Okay? It's 300 pips. And I'm risking 3. I have a 100-to-1 risk-reward ratio. You're like, yeah, but that blah, 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 blah. Okay, I agree with you. But this is just me doing technical analysis on the euro dollar for the month of August. That's all it is. Okay. Cool. Oh, which scam scheme are you talking about? Hey, Johnny, yeah, I'm glad you're back. Not sure where you went, but I'm glad to see you back. Andello, tell me about the scam scheme. Sky Killer. Here we go again on my own. Okay, anyway, so there's the thought process. I hope that helped. Okay. This ain't it though, but where's it? This is from an old discussion. Where's the, oops. Where were we? Where was it here? 4-hour daily. We had this going up somewhere. I don't remember where, but nonetheless. Okay, Aussie got crushed last night, as we already know. Great, great, great. Good, good, good. Typically, announcements in Australia flip the other way. Oh yeah, St. Thomas, nice. The DR, right on. Johnny's got class. So this must have been last night then, huh? Wasn't it? Or Sunday night? I guess this was Sunday night that I did this one. Right? Where I drew, this is actually two different boxes, a purple box and a purple box and a purple box, which turns white. But anyways, the idea was role reversal this way. This is an Aussie dollar play. So be prepared for some pretty decent up, but this isn't that important. And this was the sell area up there. So ideally, it does something like that. But Aussie has a tendency to, I don't know, like volatility creates more volatility, right? Yeah, this is interesting. I can't figure out, I had analysis on this somewhere else. I can't figure out where it is. But nonetheless, US dollar strong. It's the right time of year for the strength. But if you're going to try to flip to the other side, okay, that's how it would look. But remember, the dollar strength that seems to be appearing out of nowhere is expected, or was expected. Okay? So if we go into a smaller time frame, this 4-hour trade plan, 618 predicts a 1382. We've already kind of hit that. So it's almost like we need to refib, like kind of like, I guess we could do it this way. And it doesn't change much, but 618 predicts the next 1382, which moves this target to the pivot. Let me unclick that. Let me re-click this. Let's delete the fib. Okay. And that gets us to the target anyways, which is sell the pink zone. There's the conservative target at 106. Or sorry, 160 and a half. So maybe just take it down to 60. 60.31 versus 60.85, but whatever. So that would be the trade plan. Okay. Remember, this is the double top. Okay, all beautifully highlighted. I got the little X in there for the crossover. Okay. This was a big deal to get through this congestion, but you can see breakthrough, pullback, sell. This was a breakthrough, right? Breakthrough, pullback, sell. Cool. Anyways. All right. Oh, I know what you're saying. I don't know who you're talking about, but that's called a Ponzi scheme. Yeah. Anyways, I'm burnt and fried. I got to go. I got to jump, babe. That was real. Peace on earth. May the pips be with you. May your profits be above average. Sorry, it was a babble fest. Typically happens when I'm exhausted. So, hey, today is the Stop, Look, and Correct session at Investor Bootcamp. All members of live trading groups are meeting together. You need to post your trade plan. Okay? Post your trade plan in the community section. Let me show you just in case, because some people still don't get it. All right, Investor Bootcamp. So you log in. Great. You go to community. Great. And stop, look, and correct charts. Create entry. Okay? And you do your trade plan here. And it'll look like this. Nice! It'll look like that. Or it'll look like that. Or it'll look like that. Okay? And this is where I give you feedback. And if you're in the room with us during the session, we can talk about it, you and me. Okay? So it's cool. It really is cool. Okay? It really is cool. Trust me, you're going to like Investor Bootcamp if you join. I know it sounds self-serving, but whatever. Whatever. It can sound like whatever you want to you. It really is good. It really is good. So I'm looking forward to this afternoon. Peace on earth. May the pips be with you. May our profits be above average. Yeah. Cheers. See you when I see you.